On January 30th, 2026, a U.S. bank was shut down. Not a rumor, not a maybe. A real closure. Regulators stepped in, the doors closed, and a new bank took over deposits almost immediately. So here's the question. Was this a one-off outlier? Or the first domino of 2026? Because the way banks fail in 2026 isn't always a dramatic bank run on the evening news. Sometimes it's quieter, a slow bleed of capital, a few bad loans, and a balance sheet that can't survive one more hit. In the next 8 minutes, we're breaking down what happened to Metropolitan Capital Bank and Trust, why it failed, using the biggest public clues, the warning signs you can watch for in other banks. And the real question, could more banks collapse in 2026? This is Express Econ Geofinance Insights, where we connect money, geography, and power, without the fluff. Here's the clean timeline. On Friday, January 30th, 2026, state regulators in Illinois closed the bank due to unsafe and unsound conditions and an impaired capital position. The receiver was Federal Deposit Insurance Corporation. Then, the solution came fast. First Independence Bank stepped in, assuming substantially all deposits and purchasing most assets. The branch will reopen on Monday, February 2nd. It happened so fast that by Monday morning the bank's sign will be gone, replaced by another. Most people walking down the street in River North probably didn't even notice. The lack of drama is the point. Regulators want these events to be boring. They want you to feel that your money is safe, no matter what. But we have to ask the important question. Was this simply the unfortunate end for one small, struggling bank that made some bad bets? Or was it something more? Is the failure of Metropolitan Capital a single, isolated incident? A footnote in the financial history of 2026, or is it the first domino to fall in a line we cannot yet see? The answer matters a great deal. It tells us whether the banking system is truly resilient, or if there are hidden cracks forming just beneath the surface. The closure itself was a textbook operation. The Illinois Department of Financial and Professional Regulation made the call, citing unsafe and unsound conditions. The FDIC was immediately appointed as the receiver. First Independence Bank of Detroit agreed to buy most of the assets and, crucially, assume all the deposits. This is how the system is designed to work. It ensures a seamless transition. It ensures that not a single depositor loses a single penny of their insured money. The process is meant to inspire confidence. Yet confidence can be a fragile thing. The insurance fund worked as intended. The cost to that fund, an estimated $19.7 million, is a tiny fraction of the FDIC's total resources. Compared to the massive failures of 2023, this is a rounding error. But a quiet failure can be just as significant as a loud one. It is a signal. It tells us that the combination of higher interest rates, a slowing economy, and old balance sheet problems is beginning to claim its victims. Regulators used a phrase that matters: impaired capital. Think of bank capital as a car's shock absorbers. When you hit a pothole, a bad loan, a sudden loss, a dip in the economy, capital absorbs the jolt. It is the bank's own money, not depositors' money. Liquidity is having cash to meet withdrawals. Capital is solvency. A bank can be liquid but still in deep trouble. If losses exceed capital, the bank becomes insolvent. Regulators must step in. Impaired capital means the cushion is worn dangerously thin. Even a small pothole can cause catastrophic failure. Bad loans, market losses, or prolonged weak profits can erode capital. Liquidity can be borrowed. Capital is far harder to fix. Better to resolve quietly than risk a chaotic collapse. Public disclosures pointed to a small institution, roughly $261 million in assets and about $212 million in deposits. With about $257 million in total liabilities, net equity capital was only around $4 million. That's a net equity capital ratio of just 1.62%. It's a massive red flag, an incredibly thin buffer. For every dollar of assets, less than 2 cents of true cushion. Imagine driving at highway speed. With brake pads 98.4% worn away, you've got 1.6% of stopping power left. Fine until something jumps out. A few commercial loans go bad, or rates spike unexpectedly. You press the pedal and go straight through the windshield. That's what impaired capital means, a disaster waiting for a trigger. Almost no margin for error. A normal loss to a strong bank becomes existential to a thinly capitalized one. Many small banks fail not by doing everything wrong, but by concentrating risk. In this case, analysis pointed to a heavy tilt toward commercial lending, especially business loans. That works until the local economy shifts, borrowing costs up, demand softens, margins compress. Delinquencies rise, charge-offs rise, earnings drop, and the capital buffer gets eaten alive. When a bank is concentrated, losses arrive like a wave, not a drip. A bank can look fine right up until it's not. Because capital impairment is often the last visible stage. One big borrower failing can erase a huge chunk of a small bank's capital. What was a strength in good times becomes an anchor in bad. Hit number 1, concentrated credit losses. Banks also buy bonds, often safe ones like treasuries and mortgage-backed securities. After rapid rate hikes, older low-yield bonds lost market value. Unrealized doesn't mean harmless. If liquidity tightens, you either sell and lock losses, or borrow and raise costs. Either way, it's a pressure cooker, earning 1.5% on old bonds while paying 4.5% on deposits. You're losing money on every dollar. Earnings bleed, quarter after quarter. Weak earnings block capital rebuilding. Underwater securities are a ball and chain, limiting flexibility. Hit number 2, interest rate pressure from underwater portfolios, a financial vice, squeezed from both sides. When deposits aren't enough, banks lean on wholesale liquidity, like Federal Home Loan Bank advances. It's a tool, not automatically bad, but heavy reliance is a distress signal. Metropolitan reported $43 million in FHLB advances in Q3 2025. For a $261 million asset bank, that's sizable. Borrowed money kept it moving, didn't heal solvency. In a high-rate world, that oxygen gets expensive fast. Lenders can reprice or refuse to renew. Sudden squeeze. Forced sales realize losses at the worst time. Losses beget more costly funding, beget more losses. Hit number 3, funding stress. When all three stacked, the line was crossed. Zoom out. Early 2026 punished weak balance sheets. The Federal Reserve kept policy relatively tight, inflation still a factor, job growth slowed versus prior years. High rates didn't spike, they stayed high. On assets, underwater bonds, rising credit costs, tougher refinancing. On liabilities, depositors demand yield, cheap deposits vanish, cash flowed to higher yield alternatives, banks paid up, net interest margins compressed, strong diversified banks coped, thin cap banks didn't have room for error. The vice tightened until it broke. Does this mean banking crisis? Not automatically. It was small, resolution was quick, deposits were transferred, containment features, not contagion. But the message is clear. In a higher rate environment, failure is often stacked risk. Thin capital plus credit losses, plus rate pressure, plus funding stress. And the bank crosses a line regulators can't ignore. Metropolitan Capital isn't proof the whole system is collapsing. It's proof weak balance sheets break first. And 2026 is still an environment where weak balance sheets get tested. Here are 3 realistic paths for more failures. Scenario 1, slow drip failures, contained, local, not systemic. Scenario 2, commercial real estate stress accelerates, loss recognition spikes for banks with heavy exposure. Scenario 3, funding squeeze returns. Higher yields plus competition make unrealized losses and liquidity stress bite. The lesson isn't imminent collapse, it's that fundamentals matter again. If you want more breakdowns like this, bank stress, macro risk, and the real mechanics behind the headlines, subscribe to Express Econ Geo Finance Insights.